Hi, my name is Scott Dahl. Thank you for tuning in to another one of my podcasts. I'm recording this on April 30th. It's about 1:30 Pacific time, so it's shortly after the close. We had one of the most incredible Aprils I think that we've ever had, or we've had since the early 30s, where we had this significant sell-off, and then we had this nice thrust or breadth thrust higher. I'm going to show you what I think is going to happen with this market. I'm basing this again on technical analysis because that is my forte. Let's take a look at things. This is the S&P 500. Here are the days and the months and the years, and up along this side is the price. And you see we closed at 5,560.16 on the Standard & Poor's 500, which is right up here. We closed down just very, very marginally. Down along the bottom, you have volume. Volume's important because if you have a day or days where there's a lot of volume, you know that a lot of shares are changing hands. And when a lot of shares are changing hands, that could indicate that something's going on, perhaps a change in trend. So what I want to do now is I want to blow this chart up so we can take a closer look at individual days. This is Monday, March 31st. So I put a podcast up on that day. It's 2 podcasts back. What I recognized was an inverse flag. An inverse flag is a technical pattern. I gave a projection at that point of S&P 5,036. So you can see the crosshairs are March 31st. If we go down to 5036, which is right in this area here, this was the target off this flag. We achieved that target. More often than not, when a technical pattern gives you a target, it will exceed that target. So we went down to the target off this flag. That was the probability. I stated that at that point on March 31st. And then we traded through that area. Now, I also stated that I'll show you this trend line in a little bit. It will make more sense visually, but this is a very important trend line. This is the uptrend, the cyclical bull market uptrend that started in November of 2023, or thereabouts in that time frame. So it's a very important trend line. I said if you stayed below that for a while, then there's a possibility or a probability that this cyclical bull market has ended. So what happened? Well, we went down through it for a couple of days, and then we had this massive up day. And this was a breadth thrust. It's where all the stocks went significantly higher. Here's why I brought up volume. So if you look down here, you can see in this area that the volume was very, very high. So we knew a lot of shares are changing hands. So with high volume and this 3-day bottom and then this big up thrust, that would indicate that this is, again, a plausible bottom. And I'm going to show you more reasons why I believe that we set a bottom in this market. My podcast following that was April 16th. And what I said there is I believed that there was going to be a retest of the bottom. And there's reasons for that. Number one is these gaps, as the market went down in early April, the gaps are really important. When you have those zones where there was no trading that went on, those price zones, that becomes significant resistance when you have them on the downside. So here's April 16th. And what you can see is we went up to the gap here, we tried to get close to it, but it failed. And so it looked like to me the market was bouncing off that gap and going to head back down. Now, we did go down and test. We didn't go all the way down low, but we did a very, very important test. So this day right here, this was stopped by this long-term trend line, and it bounced off the long-term trend line. Also, if you go back, I think it was last podcast, I talked about Fibonacci retracements. This line here, the dotted line, is 50% back from the start of the bull market to the peak, and that's held it. Typically, the 50% back will hold this market. So we have 2 important support areas or support zones that this market stopped on, and then it started higher. So that would indicate to me that we set a bottom in. Another positive is the fact that we gapped higher. So you see that 2 gaps down, and then we gapped higher. So a gap is on the upside is bullish, just like a gap on the downside is bearish. So we gapped higher. That's a very good sign. And what I said in the previous podcast is a downtrend is lower lows followed by lower highs. And that's what we saw. We saw a lower low followed by a lower high, lower low followed by a lower high. But what's happened? Well, we don't have that pattern anymore. We have a higher low followed by a higher high. That's a reversal in trend. That would indicate to me, again, that the market is headed higher. Now what I want to do is I want to shrink the data down, and I want to show you again this trend line. I've shown this trend line several times in previous podcasts, and this is an important trend line. It has to hold this trend line for this to be a correction in a bull market, which I've always said this is. I've always believed this is a correction in an ongoing cyclical bull market. So if you go back to November of 2023, that's when this bull market move started. And this trend line has been long and strong. The market has gone up, and this trend line has held at this juncture right here. That's a positive sign. When I started with charting in 1976 was when I first picked this up. I charted using futures before I started getting into stocks. With futures, commodity futures, technical analysis was really important because corn, for example, if you have high heat, then that would stand to reason that would raise prices. You can't really predict that. And so that's why technical analysis was so important. And then it was kind of seen as voodoo on Wall Street. The reason, I don't know the true reason for that. I think the main reason was because Wall Street was dominated. The industry was dominated by fundamental analysts. Something happened in 2000 with the tech bubble. And I don't know what caused this, but all of a sudden, technical analysis became more respectable as a discipline of trying to predict future price movement. I can imagine that since that was a period of the fundamentals were all over the board. I mean, we really had stocks that didn't have any earnings. I mean, how can you predict something like that using fundamentals? So that's when people turned to technical analysis, and that was wouldn't say it's a golden age, but that was when technical analysis finally became respectable. But I had been using it prior to that on futures, but now everybody looks at the chart. So you see it on the news. You never saw a price chart, and from my experience, prior to 2000 on CNBC. Now they have them up all the time. So then that begs the question, is technical analysis, is it the holy grail? Well, no, of course not. Is it perfect? No, it's not. You know, Erasmus, who was a 15th century Dutch philosopher out of Rotterdam, and he was a theologian, and he said, and this is a quote from him, that in the land of the blind, a one-eyed man is king. So if you have some tool that you believe in, that you're experienced with, that you feel can give you a leg up on the rest of the competition, then you should be able to make money consistently in the market. However, it's not easy. If it was easy, everybody would be making money, and you can't predict future events. You can get probabilities by looking at the price action and comparing it to previous trends that you recognize throughout the years, but that's all you can do is probabilities because we can't predict the future. So why did I title this podcast An Island in a Stormy Sea? Because what I'm seeing now is a significant pattern, which is an island. And an island is when you have a price gap down, you have a cluster of prices, and then you have a price gap up. So let's go back to the chart. This is the S&P 500 once again, and you can see I've circled this island. We had this trade in between, and then we had a gap up. Now, as the rules are, these gaps should be somewhat symmetrical or somewhat equal, I guess would be the proper terminology. So you can see that the bottom of these gaps lined up perfectly with each other, as did the tops. So this is an island. We gapped down, we created this island, and then we gapped up. This is an island. This is a strong reversal pattern. We had a significant amount of volume at the bottom of this island. This island projects up to 5,902. So here we are right here. This island projects right up to this level right here. What's going to slow it down? Well, we've got a lot of resistance overhead. So when people say, damage has been done in the market, well, what they mean by that is you have these resistance levels that you have to get through in order to go back up to the highs, possibly even make new highs. And where are our resistance levels? Well, you've got it here at the 50-day moving average. You can see the price is stopping here at the 50-day moving average. So we got to get through that. Then we've got to get through this, which is the 200-day moving average. That's the white line. So these are areas of resistance that we have to blow through. We have to get through this peak where the whole tariff sell-off started. Then we have to get over this level. So we've got a lot of levels to be through. However, I'm going to say that the odds of probability, once again, are 5,902, which is right up in this area, right where my cursor is. That's the objective of this technical pattern, and that's where I believe we're headed. Now, it's not going to go straight up there. This is the market. And another thing, it's extremely volatile. You can see that. We didn't have any volatility last year, really the year before. Well, it's time for volatility. Regardless of what caused this, the tariffs, too much money in the system from the federal government, regardless of what, it's time for volatility. This is to be expected. But I think we're headed higher from here. So before I go, I want to show you two more charts that I feel are very important. This is, and breadth is important to me. I've explained breadth numerous times in the previous podcast, so to understand it. Breadth is participation, stock participation. So this is the breadth of the New York Stock Exchange. And you can see that we have a downtrend line here. We're approaching that downtrend line. So you can see that we gapped up. We're above the 50-day and the 200-day moving average. Not only are we above that, but it's acting as support. So what we need to do to turn this breadth positive from this particular measurement of breadth is to clear this downtrend line right here. We need to clear it decisively. The net trend line needs to become support. And then that's an indication that the breadth is back and that the market has the potential to move to new all-time highs. The last chart of the day is the New York Stock Exchange. Now, why do I like the New York Stock Exchange? It's got over 2,000 stocks in it. And this looks better than the S&P 500. And the fact that it's cleared its 50 and its 200-day moving average, also very importantly, is it's back up in this congestion phase. It's got the fighting chance to get up here to these higher levels, which are right in this area. So it looks positive. It's going to be extremely volatile. So what do you do? Now, I've said this every podcast. Warren Buffett said, when the tide goes out, you can see you swimming naked. So when this market sold off, you can see the laggards. You can see the stocks that got hurt, that went down further, and you can compare them to the winners. So what you want to do is you want to pluck those winners out, put them in your portfolio. Sure, you might take a loss on some of these stocks that you have, but the stocks that had the best strength, the best relative strength, are going to be the winners going forward. You want to be in the right asset classes, the right sectors, and the right stocks, or maybe even commodities. If these Mag 7 stocks, if they're lagging, if they're not going to be the market leaders, you need to shift that money to where it is. So if you want me to take a look at your portfolio, I'd be happy to do that. You can reach me at scott@dollcapitaladvisors.com. You can also phone me, 949-497-6366. Give me a call. Let me know if you have any questions on this. I look forward to putting more of these up. And thank you very much for your time.